Over the weekend, Venezuelan President Nicolas Maduro and his wife were captured by U.S. forces in a surprise military operation. Now, many questions remain over the future of the oil-rich nation. President Trump has said the U.S. is now in charge of Venezuela. And this morning, Maduro appeared in federal court in Lower Manhattan to face U.S. drug trafficking charges. For more on the market reaction, the stocks to watch, and what happens next, we're joined by Yahoo Finance's Ben Worschel, Inez Ferre, and Jake Conley. Ben, let's start with you and the view from D.C. here, because yes, President Trump has said we're in charge, but we've gotten some mixed messaging, and I assume there's going to be a lot of confusion in the coming days.
For sure. Mixed messaging is a nice way to put sort of the back and forth here over this weekend about exactly kind of what policy changes are in the offing in Venezuela as a result of this. As you mentioned at the top, Trump has said that the U.S. is now running the country, but it is worth noting that the acting president of the country right now is a woman named Delcy Rodriguez, who was the vice president last Friday to Nicolas Maduro and is a longtime ally and a longtime socialist as well. So she offered a statement last night that offered sort of conciliatory language towards the U.S., talked about a cooperation agenda around shared development between the U.S. and Venezuela, but exactly what that means isn't clear, and how her new administration begins to work with Trump and his team very much up in the air, especially on this oil front. I think this sort of shared development is clearly a kind of a code for oil, but exactly what that means for the U.S., for all the other countries involved in Venezuelan oil, it remains to be seen. You mentioned the kind of muted effects of this so far on oil markets and equities. I think the way this changes is on this oil front, especially with China. That's the sort of area I've been focused on this morning. Venezuela has been described as China's biggest ally in Latin America, a big consumer of Venezuelan oil. Chinese companies are involved in developing oil fields in Venezuela right now. There was a big one last year that talked about a 20-year deal between the U.S. and a Chinese firm. So that, I think, is the major front. So far, the Chinese have just offered condemnation of what Trump did over the weekend, but haven't threatened specific responses. But even Trump acknowledged last night China has a lot of levers to pull. So I think that's a big strand to watch in the days ahead.
And Ben, there's also a lot of course, international reaction here to what has happened, and a lot of speculation about whether this will enable or conversely put curbs on other leaders internationally making these kinds of moves.
Yeah, absolutely. I think one of the other major changes that could be happening is sort of whether Trump feels empowered by this, and we'll see a lot of that in the days ahead, to do more of this. Just in the last couple of days, he's talked in similar terms about Colombia, the nation of Colombia. He's talked about Greenland, and he's talked about Cuba, all three areas that he might look to do something similar in the days ahead, or days or weeks ahead, depending on kind of the outcome here in Venezuela. I think the initial reaction of Venezuela clearly shows us that maybe the economic effects could be muted. Those are a lot more complicated situations that could be a lot more complex, depending whether the markets tends to start to believe Trump may actually follow through on a lot of these new threats he's making.
And Inez, it's not just oil, by the way. We are looking, and the sort of equity market reaction aside, there are other assets that I know that you're watching closely as well related to all of this.
Right. I've been watching the metals market and watching gold, watching silver. This gold, of course, seen as a safe haven during these geopolitical tensions, but also just keeping in mind that beyond oil, there are also other resources in Venezuela that strategists point to. You have gold. Venezuela has one of the largest gold and copper deposits in the world, La Brisas. You also have other resources. They have coltan, which is a type of metal that's used in smartphones and in laptops. So you have to keep in mind that strategists have been talking about a resource war or a metals war that has been happening. Keep in mind that China has curbed their exports of silver starting in the new year. And there is sort of this idea that the U.S. is looking for resources in the Western Hemisphere. And now with Venezuela, this puts a foothold foothold on those resources. And also with Argentina and the support that the U.S. has given Argentina in recent months to support its currency, that is seen as a way of also gaining access to Argentine resources, which go beyond oil, because Argentina has lithium, they have copper as well. So this is all part of this sort of strategy to go after these resources and to keep China away from these resources.
Yeah, and indeed, the Argentinian president, Javier Milei, was one of the leaders who thought it was a good thing that the U.S. had come in and extradited Maduro from Venezuela. So quite interesting there. And Ines, when it comes to the sort of strategic importance of Venezuela with China and its relationship in terms of buying oil there, talk to us about that sort of relationship and how this now potentially changes all of that.
Yeah, I mean, keep in mind that China and Venezuela have had a relationship for decades now, and China has made major investments in Venezuela as well. And China was buying oil from Venezuela in Chinese yuan. I mean, a couple of years ago, Nicolas Maduro came out and said that they would be accepting yuan. Of course, you have PDVSA, which is their state-owned energy company, which because of sanctions also couldn't accept US dollars. But this idea that China has been wanting to do more transactions in yuan, and this is getting away from the petrodollar, because typically you have oil that is invoiced in US dollars. But this will accelerate the sort of need for central banks, or the desire for central banks to keep accumulating gold, because they are trying to get away from under the thumb of the US dollar. And these transactions that China was making with for oil in yuan, and also making investments and other barter agreements as well, that was seen as something which the U.S. didn't necessarily favor. So, of course, this changes now the dynamics between when it comes to China and purchasing oil, and the fact that they were purchasing in yuan.
Let's turn to oil prices themselves. And Jake, for that, I'm going to go to you. And you and I were talking before the show earlier, just how divergent some of the forecasts are in terms of what oil is now going to do, because this is a really difficult to predict situation.
Yeah, you see some mixed movement in the markets, right? Oil futures up about 1% roughly on both Brent crude and West Texas Intermediate. Oil companies themselves, though, moving much stronger, up 3%, 4%. Oil field services like Halliburton, SLB also doing really well. If you think about what's this going to look like on the ground in Venezuela if President Trump's idea of kind of an oil industry restart in Venezuela come to fruition, the first thing that's going to be there are these oil services companies doing workovers, looking at infrastructure. You got to remember, a lot of this infrastructure has really degraded since the Chavez days in Venezuela. There's been a bit of a brain drain of the workforce that has gone to the Middle East or gone to Houston. And so you don't have the people there, and you really don't have the infrastructure. So a lot of these oil field services companies, and then some of the oil majors, Chevron, of course, being the only one still operating there, but also Exxon, maybe ConocoPhillips, would be coming in next to try to see, okay, what is the actual benefit to us here? The kink here is going to be the kind of oil Venezuela sits on. Unlike US shale oil, which is a very light, sweet oil that's really good for converting into gasoline, Venezuelan oil is really heavy, really sour, what we call it, or more sulfurous. And it's primarily used right now for bitumen, for asphalt paving, for roofing, for heavy industrial applications.
And is all of that lower margin for these companies? In other words, we've seen some capital discipline from some of these big oil companies recently, right? They're not necessarily willing to spend as much. So that seems to me to be the lingering question here. How much are they willing to spend to rebuild in Venezuela? And what do they see as the return on that investment?
Yeah, you're exactly right. The industry right now is really at a point of de-risking. You see this across the board. All of the big majors have pulled back from exploration. They've pulled back from discovery spending. They're doing more workovers, more tiebacks to existing prospects. So the idea of not only going into a new prospect, especially for the others who aren't there, Exxon, Conoco, going into a new country, going into a really politically unstable environment is going to be a big question, because is it worth the risk, especially because of the extra money you've got to spend to refine this kind of oil. Most of that's going to take place in Louisiana, along the Gulf Coast. The industry and infrastructure is there, but still, the margins are worse because that refining takes more money. And so is Chevron, is Exxon, is ConocoPhillips going to look at this and say, this is a good business investment? Or are they going to say, I don't know, we want to wait? I was talking to some analysts over the weekend who said the soonest we're going to see real output increase in Venezuela is probably at least 3 to 5 years. Tensions need to settle, infrastructure needs to come back, and then maybe we'll see some uptick.
Well, and there's also the wild card of whether the president and the administration are going to be leaning on these companies, no matter what the business, the actual business rationale is. So we'll have to see.
Good morning to you all. Steve, I want to start with you here. Let's level set on this Venezuela situation. Why do you think the markets are shrugging this off?
Well, right now, Donald Trump's been very lucky. He's sort of had regime change without having to really invest, without much liability for regime change. We're going to have to wait and see how this goes. But right now, markets don't see any real downside. They see firms that were rolled out of Venezuela with Hugo Chavez, who lost huge assets, getting an opportunity to bring those back. And they see in the long run, this is, from an energy and pricing perspective, largely good for the United States and the Western Hemisphere. So far, Donald Trump and the U.S. economy are largely very lucky right now. I have concerns down the road, but that's the way it's playing out.
Fernando, let me get over to you. What are we're seeing a big move in Chevron. Is that justified, and why is that stock moving more so than others?
Well, I think, as you mentioned, it's the exposure to Venezuela. I would say it's not really justified. They're not particularly attractive contracts for Chevron, and there's no growth as it stands today. And if you look at the history of when there is regime change in an oil-producing nation, oil production tends to fall in the immediate term because whoever controls the oil controls the purse, controls the power. And so the question now becomes, who is going to rule Venezuela from here on out? We know President Trump said the U.S. will control it de facto, but we're still to see how that will play out. And if there are different factions within Venezuela, which we have seen over the past few years, it could lead to interruptions in production. So we don't think it's justified. As you mentioned, Venezuela has a fairly small production today of 900,000 barrels a day, and it doesn't have that much pathway to increase that significantly in the short term.
John, how does this situation impact some of the holdings over at Gabelli?
Yeah, thanks, Brian. Not much impact, I think, and I think that's why the market is so, quote unquote, shrugging it off. This situation, at least as given what we know today, not a big impact on company fundamentals. Venezuela is not a big part of the global economy. And yeah, I think it's pretty straightforward.
Does this change your thinking, John, on geopolitical surprises? If we were having this conversation a week ago, while Venezuela has been in a period of unrest, I don't think many thought they would have seen the actions that we saw over the weekend. Does this change your thinking around the midterm elections or other things that are on the political docket this year?
Well, I mean, I guess at the margin, and again, it's so early, we don't know how this situation is going to unfold, but at the margin, it probably sets a bad precedent in terms of, larger global powers encroaching on smaller neighbors. And the one that really matters to markets is the situation in China with Taiwan. But that is many dominoes away from where we sit today. So maybe at the margin, antennas are raised, but beyond that, hard to take much action.
Steve, this isn't really what Trump supporters signed up for.
No, they did not support and sign up for nation building and what looks to a lot of people kind of liberal internationalism, running another country's government. That is not what they signed up for. And that's why I think Donald Trump is walking a fine line between his own interests of sort of reasserting at what they're now calling the Donroe Doctrine rather than the Monroe Doctrine. But I tell you, there are two big things hanging out there that we're going to have to see how they unfold. The biggest topic this year in trade is going to be the USMCA and whether it comes back in some revived form that is robust enough for automakers, because he mentioned Mexico as a nation that's on his target list. And the other one is Greenland, which, though it's way in the north, is part of the Western Hemisphere. And to take any kinetic action with regard to Greenland could be the dynamic that dissolves NATO, because NATO nations would be obligated to come to Denmark's defense in that case. So when you look at why Venezuela matters, it's not because of lack of exposure on oil or how much they're doing. It's the potential for now what lies down the geopolitical road. And that's why I think that even though the impact of this is very modest right now, the impact down the road for behaviors and muscles that Donald Trump is experimenting with right now could be staggeringly significant.
Fernando, there seems to be this view in the marketplace that oil is going to stay low for an extended period of time. Do you share that sentiment?
We think there's some upward pressure in the very short term, but over the year long, we have said that the demand side is really the problem. We were talked a little bit about on this call about China and the U.S. as well, the U.S. consumer being stretched thin. So both of those aspects are a headwind towards oil prices moving significantly higher. On the other side, you have a lot of stimuli by government, both in Europe, obviously the U.S. and China, which then could pressure that demand up. But to us, we're not talking about going back into the 90s. We're potentially going back into the 70s if there is some pressure from the stimuli that I talked about earlier.
And of course, Fernando, the president now, he was talking about billions of dollars potentially going into oil infrastructure in Venezuela. How should an investor play that if they are so inclined? Is it through drillers? Is it through oil majors? Is it through oil majors, of course, like a Chevron, which is getting a pop today?
Well, I think most folks are looking towards services companies like Halliburton or Schlumberger. Those would be the most direct impacted. And then, as you mentioned, the creditor companies like Exxon or ConocoPhillips that have debits that Venezuela owes them. I think this is going to take a really long time, and a lot of these companies are going to be very slow to deploy capital into a country where there's still no clarity on how you're going to get that capital out. And so I would play this slowly, but I guess services names would probably be the choice here. Secondarily, if you want to play on the U.S. side, the refiners, especially Gulf Coast refiners like Valero, Marathon Petroleum, should benefit because they would have more competition on heavy crude that's been a lack of in the market. So with Venezuela potentially exporting more crude, they would be net beneficiaries.
Well, lastly, Fernando, help the layperson understand this. Exxon stock last year had a pretty good year with oil prices well off their highs. Why is that happening, and could that relative outperformance to the broader market continue?
Yeah, I think it's all about where you are in the cost curve. And Exxon, since 2016, has done a tremendous job of repositioning its portfolio to be at the low end of the cost curve, be that with Guyana, that they have 45% of that block, or with their acquisitions in the Permian, such as Pioneer Natural Resources. So even though oil prices are lower, their margins have actually been fairly strong. They've been free cash flow generating, not enough to cover all of their $14-15 billion in buybacks, annual buybacks, but pretty close. So they have a very low balance, very low debt. And the last part is because of passive investing, the large and mega caps get most of the flows. So someone like Exxon and Chevron is going to benefit in excess of the smaller cap stocks when there's a move up on the sector.
John, if one was bullish on the Mag 7 and AI stocks going into this year, do they stay bullish even if there is rising geopolitical risk?
I would say yes, because I think fundamentals remain very strong. We have pretty good visibility that this should be another big year of AI infrastructure investments, and more importantly, progress in AI adoption and in AI, monetization across multiple business models. So, yeah, I think only two of the Mag 7 outperformed the S&P 500 in 2025. The Mag 7 as a group contributed about 70% of the S&P 500's earnings growth. And I think the vast majority of the S&P 500's revenue growth. So, yeah, I think so long as fundamentals remain healthy, valuations are not a reason to stay away right now.
Have you started to look outside the Mag 7?
Well, I always look outside the Mag 7. Mag 7's about 30% of the S&P 500. I think, so there's still massive amount of names to look at outside of that group. And yeah, I own plenty of names outside the Mag 7, of course.
Steve, let me get the last word over to you. You know, we were talking about that this isn't one Trump supporters signed up for. Does the president now need to shift back to this affordability crisis at the same time this is going on? And how does it even pull that off?
Look, I think the president has a very, very, full plate of challenges in the country. I think the affordability crisis is one. What this president has shown himself somewhat of a genius at is not just the politics of doing what he said, but kind of the politics of distraction. If you've got a lot of discontent at home, you've got prices rent at home, but now he's basically can go out and say, hey, we're worried about our energy future. I get what our colleagues said on the table, and I completely agree with them. But in the minds of many people, he's sort of shaping, again, Make America Great Again includes making American energy opportunities and the stability in the Western Hemisphere part of that. And so he connects them in ways that a lot of other people don't. And, he's put some people in the position, we all start out and say, hey, Nicolas Maduro is a really bad guy, but, and so in a sense, he gets an interesting pass about this right now. But I think Donald Trump right now is, as he kind of moves into 2026, is going to have to figure out what is the trade and tariff picture really going to be? What is USMCA really going to be? How is, his appetite for disruption within this hemisphere going to fit with real challenges like with China or Ukraine, Russia, et cetera? So the geopolitical map continues to be complex, but he's showing that his focus is in this hemisphere and his interest in things outside this hemisphere is rather light.
Jorge, I want to go to you first here on what this does in terms of destabilization of oil supplies globally with this action in Venezuela.
Thanks, Julie. Well, I think this is important from the point of view that this involves Venezuela, a founding member of OPEC, as you correctly mentioned, the country with the biggest reserves around the world, 300 billion. But in terms of actual production, we shouldn't forget that Venezuela is just producing around 1 million barrels per day, slightly less recently. And that is less than 1% of global supply. So it's important, but it's not massive, particularly in an environment where we are facing oversupply in the market, around 3.5 million barrels per day of oversupply during 2026. So losing 1 million barrels per day would not be the end of the world.
And Andy, this also highlights an important point in Venezuela, that there is the potential reserves and production in Venezuela and the actual production in Venezuela. And there's quite a gap between the two. So how does this change that? Are we going to see a closing of that gap as a result of this?
Well, Julie, thanks for having me. Seizing oil reserves that are in the ground is completely different than actually producing those reserves and getting it to market. And given the current state of disrepair in the Venezuelan oil industry, it's going to require tens of billions of dollars just to repair the oil infrastructure, but also to repair the power grid in order to supply electricity to get that oil out of the ground. So it's unlikely to see a material increase in oil production and supplies out of Venezuela for a number of years. But the fact that the reserves are over 300 billion barrels is quite tantalizing to a lot of oil producing companies to have a look.
Andy, let's dig into that a little bit more. I was talking earlier with one of our reporters who's been covering this, and he pointed out that most of the oil in Venezuela, the type of oil it is more costly to turn into useful stuff. And most of it is used for things like asphalt currently. I wonder what you think the U.S. company appetite will be to make the kinds of investments necessary in Venezuela to increase, even if they see the allure of that increased production for them, is it worth it to them?
Well, we should separate this into the producers and the refiners. Sure. Back in 1997, U.S. refiners actually imported 1.4 million barrels a day of Venezuelan heavy oil. So the appetite from the refining industry is really there. From the producing side, when you have oil prices below $60 a barrel, it's not such a great economic deal due to the higher cost of getting that oil out of the ground, combined with its lower quality, getting lower prices than, say, WTI or Brent crude oil.
Oh, and let's look at also some historical parallels, right? Because we have seen this movie before, so to speak. Jorge, I know that's one of your areas of focus here. Whether you're talking about Libya, whether you're talking about Iraq, How have things sort of followed for the oil industry in those cases, and maybe what lessons has the U.S. learned?
I think that there are two extreme cases, if you want, from historical references in forced regime change. You have the extreme example of Libya, where after Colonel Gaddafi was killed, production never recovered. We never really went back to 1.5 million barrels per day. After so many years, 15 years, the country has broken apart, two parallel governments, civil unrest, and that's one extreme scenario. The other extreme scenario could be Syria, what we've seen in recent months, smooth transition, relatively peaceful transition, and then the country opening up for international investments. Now, where do we stand in Venezuela here? I think it's difficult to say at this point, given a lot of uncertainty, on the ground. But I would agree with Andy in that this is not going to be an easy process. I don't think it's going to be easy. I don't think it's going to be fast, and I don't think it's going to be cheap. If we really want Venezuela to increase production, let's say from 1 million barrels per day to 2 million barrels per day, that is unlikely to happen at least in the next 5 years. And the estimate is that the companies will need to invest around $110 billion in the next 5 years. That is a lot of money.
A lot of money and a lot of time, for that matter also. Jorge, I also wanted to ask you, in terms of the strategic importance and significance of the U.S. effectively now having control over that oil supply versus, say, Venezuela selling it to China or to Russia. So how does that change the geopolitical leverage, so to speak, or the balance, if you will, because of this?
I think it does change massively the balance. There was a lot of intervention from Chinese firms there still is a lot of Chinese firms in the Venezuelan petroleum industry. Let's not forget that 3/4 of Venezuelan crude exported were flowing to China. So that is sort of a big blow to Chinese refineries, particularly teapot refineries. And also, let's not forget that this was heavily discounted barrels. Now, it's not the end of the world in the sense that there's still a lot of barrels, sanctioned barrels around the world from Iran and from Russia. So Chinese teapots could still rely on those barrels. But clearly this changes the power, if you want, within the America's hemisphere, and it's a blow to the Chinese companies and to Chinese influence in the region for sure.
Andy, let's bring it back to the oil price for a moment. Understanding that there are a lot of uncertainties here, but if you had to, make a forecast as to where we're going to see oil prices 6 months, 12 months from now, given that we have seen this action and given maybe the prospects for other actions this year, what would you say?
Well, I'm forecasting that by the end of the year, we're actually going to see oil prices slowly drift up to about $65 a barrel. Now, of course, the events in Venezuela can contribute a small amount of that increase, but I also expect that we might see a change in the OPEC Plus policy, where they have been restoring their voluntary production cuts in 2025 using quite an optimistic forecast of demand. And that has just simply resulted in a significant supply surplus and lower prices. So given that their domestic budgets are under strain due to this revenue shortfall, we might see them actually reverse course and reinstitute some voluntary production cuts. On the other hand, we still have to contend with the geopolitical situation in Iran and the unrest that's occurring there, and whether we might see more action from Israel and the United States, which could potentially impact on supplies out of that region, although that certainly hasn't been the case over the last several years.
And Jorge, your best guess at what happens with supplies and the OPEC production cuts this year?
I think my guess at the moment is that the prices will continue dropping. I don't think OPEC Plus might reverse course. I think that they're clear on the direction of travel. The speed could be tweaked, but I don't see OPEC Plus reversing course. And at the end of the day, we also have some geopolitical tension that could support oil prices. I'm especially focusing on Russia, Ukraine. There could be a peace deal soon, and that could also unlock much more Russian barrels around the world, adding downside price pressure. So I guess I'm a little bit more bearish than Andy.
Oh, that's what makes a good segment, guys. We'll see what ends up happening. We'll check back in with both of you. Andy, Jorge, thank you so much. Really appreciate it.
Thank you.
Thank you.